Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to today's Q&A episode. The first question is from Sam, and Sam writes, "Thanks for all the information over the years. I listen to a healthy amount of personal health/finance podcasts and yours tops the lot." Thanks so much, Sam. That's great. I'd love to hear what your thoughts on our situation. My partner and I bought a $830,000 property in Brisbane's Bayside as our first purchase in December 23. We moved in straight away with the intention of eventually using it as an investment property. After living in the place for 18 months, we're now at the stage and looking for our next purchase based more on lifestyle factors, as this one we'll hopefully live in for a while. Here's the thing, the first property should yield roughly $900 to $1,000 a week, given it has a granny flat. With our existing debt against the property, this will make it pretty close to neutrally geared, possibly even positively geared if we refinance to a 5-year interest-only loan. My partner and I went joint tenants on the purchase. Between us, I'm the higher income earner in the top tax bracket and she's a middle income earner. I feel we missed out on our chance to negatively gear and I'm left wondering where to go from here. Any insights on how you would view these sorts of situations with clients would be incredibly appreciated. So Sam, it's a good question. And I guess in the key thing here, if you had your time again, Sam, you'd put the property 100% in your name, or if it's positively geared, well, maybe you'd put it 100% in your spouse's name, given that there's not much negative gearing or tax benefits. If the property is positive cash flow, the downside is that half of that income you're paying the top marginal tax rate on and the other half you're paying the second highest marginal tax rate. But we're probably not talking about a lot of dollars. So, if it's positive cash flow, maybe it's positive cash flow a couple of grand or something like that. And so you'll pay a little bit more tax, but we're only talking about a few dollars really. So the fact that it's not positive cash flow doesn't really worry me. I guess the question here is, does it worry me that there's no negative gearing benefits? So, because in the future, you're going to have a home with non-tax deductible debt, of course, and then you're going to have this first asset that you bought in Brisbane Bayside that's unfortunately not giving you any tax benefits. Am I worried about that? The answer to that question really depends on the components of the return. So you've told me that you expect $900 to $1,000 a week in terms of rental income. We can ascertain what the expenses relating to that rental income will be, the property's expenses. We know what the interest is going to be. So we certainly know what the cash return, the cash flow return from that asset is. The big question then is, what is the future capital growth? And so when I have a property or when there's a property that gives us a high yield, the first question that comes to my mind is, am I taking a haircut on capital growth as a result of in order to get that high yield? Because a high yield means that there's more improvements on the property, that the building value is a more substantial amount. And, when I talk about investment grade assets, I'm really talking about very land heavy assets, because obviously that's the underlying land is what we hope is going to propel the price forward, and the improvements really drive the rental income portion. So if you said, however, that, okay, I'm going to get $900 to $1,000 a week, but I expect the capital growth to be really strong, actually doesn't really worry me. It'd be nice to have some negative gearing benefits, but negative gearing's really just losing money, right? So I'm not going to just lose money for the sake of getting a tax deduction. I mean, I could donate all my income to charity and pay zero tax, and that might be a very nice thing to do, and it's very tax effective, but it's not going to help me build personal wealth. So I'm not in love with or attached to the idea of always losing money on every property investment that I hold. What I don't want to do is compromise on compounding capital growth. Because if I'm got too much money in the improvements of the asset and therefore a relatively low land value, and particularly if my land proportion of the overall asset is less than 50%, then really less than half of that value is really growing or compounding, and the other half is either staying still or moving in line with inflation, staying still or depreciating. So I want the depreciating bit or the staying still bit to be as small a possible proportion as possible, and the bit that's going to compound the larger bit. So in your situation, if you still think you're going to get really strong capital growth, 6 to 7% compounding, over the next decade, then hanging on to this asset is going to be the right thing to do. However, if you, on reflection, go, well, maybe it's not the best location, maybe it's not the best proportion of building value and so forth, I'll get rid of it. And maybe getting rid of it and buying something that is mostly land value that's most likely then to actually also give you negative gearing benefits, and something that you can gear to 100% now that you've got equity in your forever home or your longer term home, might be more tax effective. Now, that's the general rule, right? The general rule is a higher yielding asset tends to be one that has more improvements. And by the way, I recorded an episode about this back in November 23. The episode's called What Does Rental Yield Tell You About Property? And, it talks about, it's a bit of a guide. I don't have a podcast episode number. I wasn't numbering them back then. But if you just Google Investopoly or Pro Solution, what does rental yield tell you about a property? Google that. It'll take you to the episode. There are exceptions though, and I know I have an investment that's a block of units that's actually yielding gross 3.9%, which is relatively high for the location that they're in. They're in a blue chip suburb. You should expect that, because that's what I talk about in this podcast. So it's relatively high, and actually the land value of that asset relative to the purchase price, only purchased a few years ago, is very, very high. I mean, in fact, it was almost 100% when the bank did the valuation. That asset is certainly very heavy in land, but it's got a relatively high rental yield, particularly for its location and type and those sorts. So it can happen, but that's the sort of thing that I'd be looking at. If you're happy with the future capital growth, keep the asset. Don't worry about chasing negative gearing just for the sake of a tax benefit. If you are concerned about the future growth, if you're convinced the future growth isn't going to be any good, I would sell the asset, take the equity, reduce the amount you have to borrow on a non-tax deductible per portion, and then go and replace that asset that's 100% geared in your name. If you're uncertain, then I'd keep the asset and just hang on to it. But I'd be really focused on making sure that it's going to sort of keep up with the market in terms of growth, in terms of relative to what else you could have invested in. Anyway, Sam, I hope that helps, and all the people that are in similar positions to Sam. Okay, next question is from Johnny. Johnny's question relates to asset and inheritance considerations. He writes, the question is whether assets held in a discretionary trust can be transferred into a testamentary trust upon our death. We're thinking about establishing a discretionary trust for our share investment so that income can be distributed to the lower earning spouse and in a few years' time adult children. What happens to trust assets when we die? If they can't be passed on to a testamentary discretionary trust, it may be better for our family in the long term if we simply invested in the lower income spouse's name, since this would allow the assets to transfer in a testamentary trust when we die. Your commentary and considerations are greatly appreciated. Really good question, Johnny. And just for those that don't understand, the benefits of a testamentary trust, which is a trust that actually the deed is included in a person's will, so it doesn't exist until that person dies. Typically, it's an option of the executor to establish this testamentary trust, and the taxation benefits are that a testamentary trust can distribute to minors, so that is people under 18, and they're taxed at adult rates, which essentially means you can receive about $20,000 of income and not pay too much tax. And I might have told this sort of anecdote previously in the podcast, but I've got a client that inherited several millions of dollars, and she and her husband have, I can't remember now, I want to say 8 grandchildren. And so what we do is distribute $20,000 to each of those 8 children each year, which normally takes care of most of the income that comes off the testamentary trust. And then they get a refund for any imputation credits attached to dividends. And so it's very, very tax effective, right? It's a great vehicle, a testamentary trust. The funny thing is, we were just talking about, just in the last week, about whether to use a family trust. And I was reviewing a client, and it's a really interesting thing, right? Because you've got to then think about, when I think about, do we need a family trust, or should a client set up a family trust? I think about, if we had a family trust, is it going to save us any tax? I mean, that's the first consideration, right? And so then you need to think about, well, who would I be distributing to? And so in the situation where you've got two spouses, and children, minor children, right? The children are young. Well, we can distribute $416 to a child and not pay any tax. So they're going to save us a little bit of it, but it's nothing, right? You wouldn't set up a trust just to save tax on $416. That's nonsense. So I would say then let's ignore the minors. All we can then distribute is to the lowest income earner's spouse. Unless there's self-funded retiree parents with very low taxable income, something like that, or other family members we can distribute to, it starts to get a little bit sort of messy and complex, but that's something else to think about. And so in the situation where I've got really young kids and one spouse is a lower income earner, and then the other one's obviously a higher income earner, having a family trust isn't really going to save me much money in the next, well, until the kids are 18. But even then, the kids might not go to uni. Normally if the kids go to uni, they're at uni for 3 to 5 years, we can distribute to them. They might go out and get a job as well, so they might not be perfectly tax effective. So then it's not obvious that we're going to save tax. And so in that situation, in the past, I've erred on the conservative side to say, let's not have a family trust. And just like Johnny's question, he's saying in his question, let's just put it in the lowest income spouse's name. But more and more over time, particularly over the last 10 years, I'm more inclined to use a family trust because, I'm just looking at a client literally last week again, and they've now got a sizable portion of that portfolio in that lower income spouse's name. The kids now are just coming up to 18. The first one's about a year away, and so the oldest child's 17. And now I'm sort of regretting not putting that portfolio in a family trust because now it's generating quite a bit of income. I could distribute into a corporate beneficiary because the lower income earner spouse is still lower income earner, but not really low. So things change, and it's really about the portfolio size, the future portfolio size that I would put more weight on. And so if I thought the portfolio was going to be worth more than $1 million in the next 10 years, then I would be more inclined to put it in a family trust, even though I couldn't see that there's going to be any tax benefits over the next 10 years. It's really about distributing capital gains in the future as well if we're going to start selling down the portfolio. But the problem with investing is compounding capital growth, right? That's a good thing. But from a taxation perspective, it creates challenges with respect to that. So I just wanted to give a bit more commentary because that's the whole point of this podcast, is to kind of share the experiences and hopefully people can kind of learn from it and get that perspective. So I'm not saying just don't care about accounting fees and costs and compliance fees and all that sort of stuff. We have to be conscious of that 100%. But it's not a perfect science in that you add up the tax benefits over the next 5 years, compared it to the cost, and then you make your decision on that basis. It's not always going to yield the best answer. So let me come back to Johnny's question then. What happens to assets in a discretionary trust? Well, in a discretionary trust, you have a couple of roles. You've got the trustee, and the trustee, because a trust is not a legal entity in of itself, it needs a trustee, which is the legal holder of those assets on behalf of the trust. Typically, it's either individuals or companies. You've got the trustee. You've got the beneficiaries, normally primary beneficiaries or named beneficiaries. So normally that would be the spouses. And then by definition, the secondary beneficiaries are children of those spouses, parents, cousins, related entities, etc. It's quite a wide definition. A discretionary trust gives you a really wide definition of who you can distribute to. And the key one, though, is the appointer. And the appointer in a trust is the person, the individual that can replace the trustee. And so what has to happen is in your will, you need to appoint a replacement appointer for the trust. And essentially what that does is really just hand over control. So to use an example, I've got a family trust, of course. If I pass away and my wife passes away, in my will, I will make my 2 sons appointers, for example, or one of them, or whoever the executor, etc. And essentially what I'm doing is just handing over control over that trust. Now, trusts vest typically after 80 years, so they're not going to last forever. And at the end of that 80-year term, all the assets have to vest, which means all the assets have to come out of the family trust. But, usually it lasts at least a generation or so. And we don't see too many trust vesting, although it's going to become a bigger issue, of course, or a more common issue, I should say. So in Johnny's situation, it's a bit of a very long-winded sort of way of answering his question, but it's a great sort of I guess reminders sort of share those experiences and that I'm sort of contemplating. And actually, it's something we sort of debate quite a bit internally when we work. We all work on one plan together. We have that discussion about whether, what sort of entities we want and whether they're worthwhile. So in Johnny's situation, I would put greater weight on saving tax while you're alive than saving tax when you pass away. Because firstly, passing wealth in along via a family trust is a great way to deal with intergenerational wealth, and it's pretty tax effective because you can still have flexibility around distributions, and you can even distribute into a corporate beneficiary and cap your tax rate at 30% and get a credit for any tax that's paid as well. So it's really flexible anyway. So a testamentary trust has greater tax benefits than a discretionary trust, but the discretionary trust is pretty good anyway. I think the whole decision around financial planning is about funding your own retirement and making that as effective as possible and as tax effective as possible. And if you do that, chances are you'll leave more wealth to, your beneficiaries in the long run. If I minimize my own tax and maximize my returns, then there's greater chance that there's going to be more money left over. So I would prioritize making the best decision for yourselves. And if you thought that a discretionary trust is warranted, then I would go that way. I wouldn't put it in the lower income earner's spouse's name just because I wanted eventually to get those monies into a testamentary trust. Because what you might end up doing is paying more tax while you're alive, eating away at the balance, and you put a lower balance into something that is, a bit more tax effective. Anyway, that's how I would approach that question, Johnny. I just wanted to talk about the things we think about when or whether to establish a family trust, because it can be a little bit more of an art than a science decision. Okay, next question is from AJ. AJ writes, long-time listener, I must say the education level you provide to the community is something you should be very proud of. Well done and keep up the good work. Looking forward to 3 episodes a week. You never know. I get a lot of questions and I enjoy doing it. Certainly not off the cards, but thanks so much, AJ. I am really proud. And I've said it a couple of times, this Q&A edition has really increased the level of enjoyment, because as you see, like the past question, I can answer the question, but there's always brings up other things that, there's other items that I like to talk about that aren't big enough to make an episode about, but are important enough to mention. And I think this Q&A format allows me to do that as well. So anyway, AJ writes, he was listening to episode 358 today and have a couple of questions. And so episode 358 was called How Much Wealth is Enough? And there was kind of two sort of main themes to the episode, which was, my personal view is to, invest slightly more than what I think I need to hit all my goals. And if I have money left over, I go and spend it on holidays pretty much, so try and have that balance, which is, work hard and invest hard, but also enjoy today as well. And the other element to that was, thinking about how property integrates with a retirement strategy, and how, gearing in retirement is less appropriate and less effective, and how property is a liquid and generates a relatively low income net of expenses, which also doesn't really suit us in retirement. Whereas those two things, gearing and an asset that gives us less income, is perfect for us. In fact, very powerful for us in the accumulation phase when we're working. So it's really about recognizing then how asset allocation kind of needs to change, if not before retirement, but certainly as we get deeper into retirement, and then how those assets are held in terms of fully utilizing the tax benefits of superannuation. So anyway, if that's of interest, go back and listen to that episode, or listen to it if you haven't listened to it already. Anyway, AJ's got a few questions and he gives me a bit of a summary of his situations. I started to read the questions, but I don't think I need to really share his situation, other than him, AJ and his wife are high income earners. They've got 3 investment properties. They're doing a development, but essentially by the end of that, they'll have 7.2 million in property and 3.3 in debt. He's 37, his spouse is 40. So, they're in a really strong financial position. Actually, AJ, part of his remuneration is an employee share scheme. In the podcast, in that episode, How Much Wealth is Enough? 358, I shared some ideas on, how much money do you really need in today's dollars. So that's an important point to make to enjoy a comfortable retirement. And actually, I concluded that if you want $200,000, if you want to be able to spend $200,000 in retirement for the first 20 years and then reduce it by 30% after age 80, because typically people don't do as much traveling, at that age, might continue to, but, just realistic planning. I said you needed a total of $2.9 million inside super. And so AJ's got some questions in regards to that, and I'll just read them out and I'll answer them in order. You mentioned 200,000 of income and 2.9 million asset base is required. Does that take into account 80% gearing into consideration? And is that based on $2.9 million today? So that is no gearing. That's all equity and that's all inside super. So I guess what I was trying to do in that podcast is to invite people to think about, and AJ, you can think about this too. If you have 3 investment properties and you sold one each year post-retirement, and I'm not suggesting you do that, right? Do this. You don't necessarily need to be this aggressive, but just theoretically, you sold one when you were 60, one when you're 61, and the last one when you were 62. And you worked out at that time, by the time you get to that age, after paying capital gains tax, selling costs, repaying the loan, etc., how much money will you have left over? And then can you eventually get that into super? And that's why I invite people to think about it now, because the answer will be you'll probably have a lot of money and you can't get it all inside super, which is a real shame then, isn't it? Because if you say, well, if you think, oh, look, I'll have 1.5 million in super and then I'm going to have like 6 million or whatever outside of super, you immediately look at that today and go, that's tax ineffective because we can have $2 million each inside super and pay no tax, so $4 million. So if I'm going to have a net wealth of more than $4 million by the time I get to 60, I want to get it all into super because that's the most tax effective. And in order to do that, I'm probably going to have to sell my property assets in order to do that. And I'm not saying that should suit everyone and everyone should do that, but it's something to really think about if you want to make sure your asset base is as effective from an investment perspective, but also from a taxation perspective. So yes, AJ, that's a completely ungeared amount in today's dollars, right? So if I'm retiring in 10 years' time, you can just use an online inflation calculator, put 2.5% in, work out what the future value of that is. So I just punch it into a calculator, 2.9 million in 10 years' time will really be 3.7. So, if you're 50 today, you got to work out, if you sold everything after tax, will you have $3.7 million? AJ goes on to ask, is the $200,000 of income that the $2.9 million is generating, assume 7.5% return? Normally I go 7% in assumptions. I haven't opened that model. Pretty sure it's just 7%. I assume 7%. I think that's a pretty conservative return. And the reason I've made it conservative is to deal with sequence of return risk, which means, we've got some volatility in markets in the first few years of retirement. If we have negative return years, that's going to have a compounding impact. And so to deal with that risk, you back off the assumption in terms of returns, and I've gone 7%. Should the primary place of residence be considered as part of that asset? No, absolutely not. These are just investment assets that we're using to fund the $200,000 income. Your home isn't part of that unless it's part of a downsizer strategy. But then I'd be really careful with that as well. I mean, you really want to be really conservative with the numbers. If you say, look, I'm going to live in this home and in 10 years after retirement, I'm going to downsize, and then some of that's going to sort of fund retirement. It doesn't always work that way or work out as you hope. So just be really careful about that. But generally, ignore the home. What should the capital growth rate I factor into my projections of the properties? I currently project for the next 10 years at 5%. Look, it's a good question. We typically model at 7% on the basis that over the last 40 years, the median house price in most established capital cities has achieved at least that. And then if we investing in investment grade assets that are better than average, remember the median is just the midpoint, the middle point of all sales. So 50% of assets have done worse than that, and 50% of sales have done better than that 7%. And so the idea is that if we're applying asset selection fundamentals and we're buying investment grade assets, then we've got a greater chance of doing that. But another way to kind of work out are you on track, do you need to invest any more, is back off the capital growth rate and see what happens. So if you can assume 5% capital growth and you work out you're already on track, well, that gives you some confidence, right? Because you only need 5% to hit your mark. Whereas if you're in a situation where you absolutely need 7%, if it's under that, you'll miss the mark, well, then it's sort of borderline. And that's why I always say, well, I said in that episode, I invest as much as I need to, plus a little bit more. So I want to be quite conservative about returns. I want to make sure that I don't want to overspend today and risk not being okay or not being able to achieve my goals in years to come. I'd rather sort of spend less today and hit those goals. So that's why actually what we use in a model is one thing, and then how we sort of sensitize that model and see how sensitive are we to these sorts of assumptions is critical to assess, are you on track? And AJ, his last question is based on the above figures and targeted 200,000 income that I want. Do we have enough? That's a great question, AJ. That's what our clients pay us to do, is to build a financial model and model it all out. I can't answer that. Well, I mean, I can answer it, but it's many hours of work to answer the question. I'm not in the position to be able to do that, but I can say that, you're 37, your wife's 40. So let's say 20 years to retirement. Actually, hang on. I think AJ said he'd like to stop working in 10 years' time. Okay, so if I've got, let's say you've done the developments, all that sort of stuff, you've got 7 million of debt with about, let's be conservative, 3.5 million of loans. So you got $3.5 million of equity. If we go 7% over the next year, and they're all in Brisbane, I think Brisbane, I don't think it's a silly idea, but the properties will then be worth 14 million. Let's be a little bit more conservative and say 12, if you like. And you still got 3.5 million of debt. Allow maybe $2 million for capital gains tax, just as a rough calc, assuming your debt is your cost base, which would be most of the time for people. I mean, sometimes it's less, but anyway, $2 million. So you go $12 million, repay the loan 3.5, pay your CGT, say 2 million, gives you about $6.5 million. And I said you needed 3.7. The difference in your situation is you're starting 10 years earlier than what my model projected, which can have a sort of impact. But look, I would say that from rough numbers, looking at your situation, looks like you're well on your way to be able to achieve those goals. The question, though, will be how are you going to achieve it, right? Because that's your challenge, is that, let's say you're 40s now, I'm just going to round off the numbers. When you're 50, you're not going to be able to access super. So you're going to need to rely on your asset base outside of super. That's your 3 investment properties. At that time, they're going to give you some income, but not a lot of income. You're then going to, if you stop working, be locked out of your borrowing capacity. So you won't be able to refinance or access equity. That's going to be a real challenge. So what you're going to need to then think about is, and this goes to the episode that I spoke about, is that you need to think about asset allocation. So again, you might not necessarily sell all 3 properties at when you turn 50, bang, you're totally out of the property. But I think to achieve your goal, you're probably going to need to sell 2 relatively quickly. So you're selling 1, firstly, to reduce debt, and the second one then to create some liquidity, so give you assets that you can use. And then you might keep, 1 for another 10 years, for instance. But looking at the broad numbers, roughly, it looks like you're on track, but you really do need to build that strategy out to work out, well, how's it going to help you stop working or at least reduce working hours at age 50? And look, there could be a lot more other considerations in there as well, but just from a cursory review of answering this question in the podcast. And of course, none of this is advice, information only, just for those that are listening. Of course, I haven't done all the work to be able to give advice. Okay, I'm going to squeeze in one last question today from Chelsea. Chelsea writes, love your podcast, huge fan. Thank you, Chelsea. We live in Adelaide and have 2 investment properties in Sydney, a 2-bedroom Art Deco apartment in Edgecliff and a 2-bedroom apartment in Mosman, both great locations. Give me the addresses, I haven't looked it up, but great locations from a suburb perspective. Both properties have done reasonably well over the years. The Edgecliff was bought in 2006 and has increased substantially, while Mosman was only bought in 2017 and has had less growth. Of course, less time. Although, they're apartments, and apartments have done relatively well in Sydney as a general commentary relative to other markets. We're still happy with both assets. Recently, New South Wales state government changed the development zones and are now and I'm now trying to think through the future of these assets. They have been limited in supply due to NIMBY, which is not in my backyard, and council protections, but that has really changed. The Edgecliff property is within a 400 radius of a train station, so has development potential. So I think that could be positive. The Mosman property is a heritage property, so whilst it's within a development zone, it doesn't have the development potential. I have seen in Mosman in particular a lot of properties that have been amalgamated and sold to developers. This means more supply will be coming on. However, I think it will be at the high-end luxury, so may remove stock from the more entry level, so perhaps not an issue. I guess overall, I'm keen to hear your thoughts on whether you think these assets will still be in high demand, and will we still experience property price growth in the future given the changing landscape around us. Thanks in advance for your insights. Chelsea, I don't know. I have no idea. And, it's not really necessarily in the purvey of this sort of podcast or what I do. But the reason I wanted to squeeze this answer in is I think the answer is really simple. It's not a what question, it's a who question. So you're asking, what should I do? That's not the right question, I don't think, for you to ask, Chelsea. I would invite you to ask the who question, which is who do I need to speak to understand the implications. That's critical. The reason that's critical is what you need is someone that's in the market all the time, every day of the week, that's been in these markets for more than a decade. Hopefully even a couple of decades would be perfect, because they're going to have the hindsight and the foresight, hopefully, to give you some really good advice. Whereas if you rely on data to make this decision, that's not a good, I wouldn't rely on data, because I don't think you're going to be able to get reliable, relevant data, timely data that's going to help you make that decision. Most of it's either going to be irrelevant or not timely, outdated, this sort of stuff. So, I would reach out to Veronica Morgan, who is a buyer's agent in Sydney. I respect her greatly. I think she really has a deep knowledge of these markets, particularly these locations. So I would reach out to her and ask that question. And I'm sure she's going to have a really intelligent answer for you, an educated answer. And it's important you do make the right decision, right? You don't want to jump at shadows with property. When something changes, you might think, how is this going to change? And you don't want to predict that change necessarily, because sometimes and quite often nothing really changes and the property keeps on growing and everything's fine. So quite often I think do nothing is the right approach, but I would speak to Veronica about that. The reason I want to answer this question included in today's episode is just because I knew it was a quick answer, and I think it's a really good lesson for us all to learn if we are approached with this sort of question. So if we've got this question for a client, we will always ask the who question, not the what question. I think it's a really valuable thing, because what you want to do when you make financial decisions is, if you don't have the experience, you want to lean on someone else's experience. You don't want to look back in 20 years time and go, I shouldn't have sold those properties, or, I should have sold those properties, and kick yourself. You want to make sure you make the best educated decision. And quite often it's a who, not a what question. Okay, I'll leave it there for today. Tomorrow I've got I think a really interesting episode for you. We talk a lot, and I've received a lot of questions about how pooled super products aren't so attractive from a capital gains tax perspective. Where you have an unpooled product, you can eventually avoid paying any capital gains tax on your super for your entire working life, or for your entire life, really. Anyway, I'm going to unpack that tomorrow. Really important episode. I found it really interesting. I hope you do too. And until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.